Now, next week, we're going to get some very important things. We're going to get the Fed meeting, obviously, and on the 29th there, and the decision, which, again, the Fed is expected to pause, and, again, making another monetary policy mistake. And we're going to get the press conference from Jay Powell, which, again, at his last press conference on December 18th, told us it's clear that we've avoided a recession. Those words are going to come back to haunt him because a recession is about to start. We see it begin at some point in the first or second quarter in all likelihood, but it is going to happen. The recession indicators are saying it's going to happen, and you'll see some of those warning signs in today's video. We're going to get, though, next week, we're going to get the Fed. We're going to get consumer confidence at the start of the week there on Tuesday. Wednesday, the Fed will get the GDP for the first quarter come the day after the Fed. And we're going to get a lot of the Wall Street darlings next week. We're going to have Microsoft, and we're going to have other Magnificent Seven stocks and important tech earnings coming, so we'll be watching that. But we'll get that GDP on Thursday, and then we'll get the PCE inflation data on Friday, January 31st to close the month out. So again, we'll be watching all of this very, very closely. That's what's in store for next week, and we're likely going to get a Fed sell-off as we're having the rally ahead of the Fed that probably will give us a back test of the bull flag in all likelihood on the S&P 500. But this week, we got some very important information and more signals, again, warning you, warning me that we're about to have a recession. And these are the signals that the Fed continues to dismiss. Now, Wednesday, we got the leading economic indicators, which again is predicting that we're about to have a recession. It turned down again. We have existing home sales, which is predicting we're about to have a recession. And we have consumer sentiment, which also is predicting. We got the final number for consumer sentiment, which is also predicting we're about to have a recession, at least that there is risk of one. Economic data that we're getting this week, again, telling us, hey, we're going to have a recession. Existing home sales, good sign. A recession is coming. It's peaked, it's dropped, and we've seen the 30-year rise as it's dropped. Again, higher rates lowers the incentive to buy a home. Here we have the same thing. We have the rising rates, the drop in existing home sales. The Fed was in the rate-raising campaign, the Fed funds rate in purple here, the 3-month yield in red, and they're dropping. The Fed has started their rate-cutting campaign. We've seen the yields turn back up, talking about the 10-year yield, and here with the 30-year mortgage rate, we're seeing it turn back up, but it did the same thing back over here as we moved into recession. It had peaked. We began to see the housing bubble begin to pop, which the Fed again told us didn't exist. There is no housing bubble, Bernanke kept saying. He was a Fed chair back then, in case you don't know. The same thing. Rates rose, housing bubble popped. Again, rates, 30-year mortgage rebounded back up. The Fed began to cut rates, and even after, as we were moving towards recession, which again, they don't know that we're in recession until long after the fact, rates went back up, and again, the Fed rate went down. The same thing happening as we had happened over here right now. And again, this is a red flag or warning sign that we're going to get a recession. Now, we just got the final number for consumer sentiment. It was expected come in at 73.2, came in at 71.1 for the January number. The final number, by the way, down from the previous reading of 74, which I think was revised upward slightly. Let's take a look. No, it was the same, 74. But again, here, take a look at this. This is the consumer sentiment index. We got the final number. What's it doing right now? The stock market's going higher. Consumer sentiment is making a lower high. Concerns about inflation. It's already peaked. It's come down. It's diverging with the stock market. That's what it does right before the recession. In red is the S&P. In blue is the consumer sentiment. It's diverging with the S&P here. It diverged with the S&P right before the recession and the pandemic there. Over here, you had a divergence between the S&P. It went higher, made a lower high, began a drop. right before the recession began. Same thing in 2000, again on a closing basis. Now, in 2000 we had a lower high setup with the actual peak, but on a closing basis we got a higher high and a divergence with consumer sentiment again just before the recession. Divergence is set up and at the with the bursting of the tech bubble and the financial crisis. The stock market dropped about 20% right about that time, shortly thereafter, surrounding those divergences with consumer sentiment. So again, the drop and now the divergence, a rebound back up, but now it's dropping back down. Again, completing this divergence, which again, I do believe the S&P is going to go a little bit higher, but this is warning, hey, we're at risk of a recession. Even after the inflation of 2022, reaching the CPI reaching 9%, we've never really climbed back up to the highs. We had this drop here surrounding the inflation, and then again, now this drop right here. And that's creating even this larger divergence, by the way, with the previous peak in 2022. But because of the inflation, there has been this lackluster, if you will, consumer sentiment. So again, another signal that I think is predicting that a recession is at risk of happening, the divergence between the S&P 500 and the consumer sentiment index. The larger divergence and the recent drop that has given us another lower high could even make the case for the 2022, which was not associated with the recession. The divergence between the two there, I should say right there at the 2018 peak. In 2022, the recession indicators had not yet flashed. Existing home sales, consumer sentiment, these things warning we're at risk of a recession. And we have a very similar look to what we had right before previous recessions. So again, I think both existing home sales, consumer sentiment, both warning we are at risk of a recession. Now we have the leading economic indicators warning we are going to have a recession. And again, a beautiful track record that has not been wrong. Turning up in November for the first time in 2 years, we've now turned back down in December. It was expected to come in at negative 0.1. It came in line with expectations, but again, it's warning we're going to have a recession. It was up there in the previous month. LEI, the leading economic indicators or index, if you look at it, it's warning we're about to have a recession. Please support the channel with the link directly below. That allows me to be able to provide you this information. If you like the charts, you like the indicators, let me know that by supporting the channel. I just put all the information out there and ask that you partner with me, do what you can to help out. Most YouTube channels have sponsors. That's how the channels survive. I don't choose to go that route. I turn those offers down. They contact me all the time, and I don't want to sell you stuff. I ask that you partner with me and support the channel today, but I need to hear from you in order to make it work. If you could take a moment to do that, I would really, really be grateful. Thank you for your consideration for that. Watch this video all the way through. You're going to be amazed. Again, a lot of recession signals are flashing that we're being told we're not going to have a recession. That's telling us, again, the stock market is likely going to peak a month or two before that recession begins in all likelihood. Your yield, again, the freak out right now is about inflation, which, again, inflation is going to go higher. It did in 2007 and 8, yet the Fed still did jumbo cuts. And again, the Fed is second guessing themselves as we see the 10-year yield and 30-year mortgage rates go over 7%. It had recently done that. The Fed is freaking out. And again, bond market rising ever since September, since the Fed cut back over right here, and the election and Powell believing the Keynesian nonsense. We're going to have this big, the tax cuts and tariffs are coming as a result of Trump winning the election. You got Powell now going, well, there's no hurry to cut. Good place. We've avoided a recession. Fed's focused on inflation when they should be worried about the recession. A mistake they made in 2007. Inflation went higher. The Fed still did the jumbo cuts. The recession still happened that they told us wasn't going to happen. We had the same thing happen here. Bond market freaking out about inflation. Now, I told you again, we'd likely get a bottom off of that trend line, which we did. Still may go up here and form a double top, but it's possible We've also peaked at the resistance zone. Both scenarios are possible. I think we go much above this 5% area, but it's possible we have this peak here, very close to this peak over here into the resistance zone. But the bond market freaking out about inflation, concerns about inflation, concerned about inflation. The betting markets, Fed fund futures, the herd concerned about inflation. Currently, the Fed funds rate is at the 425 to 450 area. And again, the Fed is expected to pause here in January and in March and in May. And again, you can see the dates over here in January, March, and May. And the Fed may give us one cut sometime between June of 2025, between June of 2025 and all the way down, possibly one cut between June of 2025 and October of 2026, the end of October. Now, again, we're going to have a recession, and this is going to end up being wrong. Just like they told us we were going to get massive cuts in 2024, we only ended up getting rates dropping 3 times, equaling 1%. Again, we're going to, and again, they don't believe that we're about to have a recession, just like the bond market. The Fed has lowered their estimate from in September to 4 cuts in 2025 down to 2. Probably, this rally we're getting, the President made some comments Thursday about rate cuts and lower rates, and the stock market extended the rally on hopes of that. I was going to throw cold water. The Fed's going to throw cold water all over that. They're going to dash those hopes and, again, continue their hawkish stance. Right now, they're hawkish when they should be dovish. Back when inflation was rising and they told us it was transitory, they should have been hawkish when they were dovish. The Fed does the opposite of what they should be doing, largely because they believe this Keynesian nonsense. Now, earlier in the week, we got the LEI, the Leading Economic Index, or indicators. The LEI, again, peaked 2 years ago. It's been declining. We just finally got an uptick with the previous month's reading, and now it's turning back down with this month's reading. This blue line right here is the Leading Economic Index, and it's warning you we're about to have a recession. It starts to turn down ahead of the recession. Now it's being validated by the uninverting of the yield curve and the Psalm rule being triggered and all these more recent signals happening that are validating this. But it's warning you, hey, a recession's going to happen. The coincident economic index is this other line right here, this black line, and that turns with the economy turning down, like you can see over here. It turned with. The leading indicator turned down before. Over here, again, it turned down with, and the leading indicator turned down before. Now, again, the Conference Board is basically repeating the same stuff the Fed is saying, and that we're dodging a recession. And again, their own indicator, they have some other things that cause them to say that, but again, this is the trustworthy indicator. How they're saying that, I don't even agree with what they're saying. Nevertheless, it's a very reliable indicator, and it's telling you, hey, we're going to have a recession. You can ignore it. You could say, oh, no, this time is different. Yeah, right. Now, in the previous chart I showed you, the LEI, the Leading Economic Index, was updated. This one isn't updated yet for the reading that just came out. And it did decline for our current reading that we got this week. As I mentioned, again, this is warning that we're about to have a recession. If you look at this, every time we see this leading indicator begin to turn down, recession follows. Here, we had it with the self-imposed shutdown of the economy, with the pandemic. Over here, it began to turn down and into recession in 2007 that began in late 2007. It continued to drop. Over here, with the bursting of the tech bubble and peak in the stock market in 2000, again, priced in the recession, and we got the recession in 2001. Again, it did it. Back in the early 90s, you'll notice it did not do it, have a drop of greater than 5% on it during the so-called soft landing in the 1994-1995 period where they're telling us we had a soft landing. This was not signaling a recession. Same thing over here with the 80s. There was no, drop of greater than 5% from the highs in the 1980s. or let me correct that, in 1984 and 85, as we're being told the soft landing, this was not predicting we were going to have a recession. You have these recession indicators flash that we're going to have a recession, and then we don't get one. Believe your soft landing nonsense. The recession signals were warning we weren't going to have a recession, and that's why I tell you is the times that they claim that are still part of the economic expansion, a larger cycle of falling rates or raising rates, which you'll see in this video if you watch this video all the way through. So again, it's Kool-Aid for people that believe a bunch of nonsense. Its policies lead to negative outcomes, period. You can see, again, the downturn here, and then, again, the rise back up here. We had a couple of those recessions trying to, as Paul Volcker tried to stamp out the inflation of the 1970s. And over again, the leading indicator has been right. This is why I'm so critical of this soft landing nonsense, and you'll see it on the next chart I showed you. But again, this is telling you you're going to have a recession. Now, you can ignore it. You can say, oh, this time it's different. It's not different. We're going to have the recession. The Fed is arrogant. We're in the warning signs like this signal right here. Even the conference board is denying we're about to have a recession. Claudia Sahm with her indicator with the Sahm rule. A warning, we're going to have a recession. Absolutely incredible. Here we have the leading indicator, and again, from the peak down to the trough low and declining for a couple of years, telling us we're about to move into a recession. Again, dropped more than 5% from the high here. And again, it's warning when that happens every time you've had a recession. And again, while we've chart's not updated, this is still the previous month, but while we've turned up the previous month and then turned back down for our reading that we got earlier this week, for the month following, again, we've seen this decline sharply. And again, we saw that with the pandemic, associated with the pandemic and the self-imposed shutdown of the economy over here in 2008 with the recession that began in 2007, and then over here with the bursting of the tech bubble again in 2001. We had that recession. The stock market peaked in 2000 and again dropped greater than 5% over here in the 90s, over here with the recession in the 80s. Since the 1960s, we know that, again, every time we've seen this drop of greater than 5%, guess what? Recession has followed. But guess what? Soft landing in 1994-95. Did we drop more than 5%? No. Was this predicting a recession? No. You get these signals predicting a recession and we don't get one. I'll believe your soft landing nonsense. In 84 and 85, where we dropped with the leading indicator more than 5% off of the highs? No. Again, a bunch of made up fairy tale nonsense. Say we've avoided a recession when none of the recession signals have flashed. We're still in the economic expansion, not yet reached full employment. Watch the video all the way through and you'll see what I'm talking about. You need to know this stuff because a recession is coming. We have many, many recession indicators that are telling us that. Just quickly, I want to just show you a couple of things. First of all, there are many, many signals flashing that we're about to have a recession or at risk of a recession. Now, at the last FOMC meeting during the press conference, Powell said, I think it's pretty clear. We've avoided a recession. The outlook is pretty bright for our economy. And he said that at the press conference on December 18th. Recently, I posted 11 on social media, 11 recession warning signs that are happening right now that are either, again, already telling us we're going to have a recession or warning that we are at risk of one developing. I went through them, and the Sahm rule, the uninverting between the 10 and the 3 month, also the 10 and the 2, deterioration in the labor market, industrial production. Chicago PMI has dropped below 40. Capacity utilization index, existing home sales, and so on and so on. Consumer sentiment, the LEI, housing starts, ISM manufacturing. There are others. Now, Again, you got all the experts on the financial channels telling us we're not going to have a recession. You have Powell telling us we've clearly avoided a recession. You got everybody on social media believing, again, we've dodged the bullet of a recession. We're going to have this soft landing. Again, it's fairy tales. The conventional wisdom, the sentiment of the herd is there's going to be no recession. There's going to be a soft landing. The bull market will just continue forever. We've have a new bull market. Actually, they're telling us 2022 sell-off. That the people that told us it was not going to happen are now telling us, oh, that's the bear market. It's already over. And we've just started. We're just 2 years into a brand new bull market. And in fact, the bull market never ended from the 2009 low. Oh, we dropped more than 20%. The bear market. Poppycock. We've had several declines in the bull market of more than 20%. In 2011, we dropped 21%. In 2020, we dropped 35% in 3.5 weeks. Was that the shortest bear market in history? No, it was a major correction, a crash in the larger bull market. In 2022, we dropped 27.5%. Percentage drop of more than 20% is just some analyst's definition of a bear market. All of those cases, we never took out the 200-week moving average and stayed below it. Each time we dipped below it or bounced off of it or dipped below it and rebounded back above it. The same with the 50-month moving average. Take out those moving averages, those long-term moving averages to have the bear market. That's what defines the bear market. Not some percentage drop. Having said that, again, here in the upper window, I have the Fed funds rate. Here in the second window down, I have the unemployment rate. The third window down, I have the 10-year minus the 2-year yield curve. These things are warning you we're about to have a recession. Now, the herd believes that the rate cuts are bullish. The rate cuts are, in fact, bearish. They that because we had all the stimulus with the self-imposed shutdown of the economy with the pandemic over here, that drop of 35%, but then to government stimulus and the Fed QE 2.0 saw a rebound markets. And by the way, they gave us the inflation we now have, along with a few other things. That inflation is caused by increasing the money supply or increasing a government spending. And it's hilarious because now the Fed, Powell's all worried about the tariffs and the Fed members all worried about the tariffs. The tariffs aren't inflationary. Their policies at the Fed, the things that they've done, and the crazy government spending, those things are inflationary. Those people that are all worked up and concerned about the tax cuts and the tariffs, and again, booming economic growth, this is going to lead to inflation. Economic growth does not create inflation. It actually brings it down, largely because of competition. But again, you get the Fed and they believe all this Keynesian nonsense. Why they keep not seeing recessions. That's why they keep telling us inflation is transitory. That's why they told us there was no housing bubble back in 2006 and 2007. We have avoided recessions. Right now they're saying it, and that's they were saying back in 2001 and in 2008 and late 2007 weren't going to have recessions, and we did. This chart right here shows the Fed funds rate, and it's starting to go lower. And again, the herd believes that the rate cuts are bullish. Now, this is the self-imposed shutdown of the economy with the pandemic. But look at the last recession. And again, in 2007, the stock market peaked. Fed began to cut rates. This is the Fed funds rate, okay? And it began to go down. And we saw a rounding bottom on the unemployment rate under 5%, which is considered full employment. Also had an inverting of the yield curve ahead of the recession, and it also uninverted, and we began to see the steepening of the yield curve between the 2 and the 10. We began to see the unemployment rate begin to soar surrounding the beginning of the recession, and it started turning up ahead of the recession, which is what we have right now, and we saw the Fed begin to cut. By the way, they did it in January of 2008. Hard to see. If I zoom in on it, you'd be able to see it. But January of 2008, Recession began in December of 2007, and they panicked and they did an emergency cut, which is, by the way, what I believe they're going to do right now. A pause out of the Fed next week, making another monetary policy mistake. They should be slashing rates right now because we're about to move into recession. They're going to pause. Later, they're going to panic. Stock market finishes the blow off top, it peaks, and it begins to turn down on inflation concerns. I think that we could see an inflation freakout, concerns with the tariffs, which again, not the cause of inflation. If you believe the nonsense that the Fed believes and the Keynesian nonsense, they are married to that position. Why they keep making monetary policy mistake after monetary policy mistake. Nevertheless, I digress. They panicked. They began to slash rates. The market had dropped by 20% and the Fed panicked. You're going to see the same thing happen this time. With the bursting of the tech bubble in 2000, the same thing. The Fed began to cut rates. And just quickly, let me just go back into 2000 and 2001. Here you can see the market topped in March of 2000, went back and tested the high, got a slightly lower high in August of 2000. It dropped by 20%. Fed panicked. January 3rd of 2001, they had an emergency meeting and they did a 0.5% rate cut, and then they did another one. Next meeting, we got a bounce and then a much, much bigger drop. Rally on hopes of the tax cuts, which is what you're going to see this time around too, but it was a sell the news event, and again, it ended up selling and eventually got the 9/11 tax over here in September that gave us another push down, and the markets closed briefly. Here is the uninverting of the yield curve. So you see what I'm talking about. Again, the market began to drop by 20%. The Fed panicked. In the bear market, you're going to see something very, very similar to that. And they did an emergency cut. This is the 2000 and 2001 peak and start of the bear market there, bursting of the tech bubble. Here's what happened in 2007. Pardon me. We had a peak in July of 2007. We had the uninverting of the yield curve before that. We sold off by 12%. We went back up and we went slightly above this peak right here by 20 points. And then again, over 20% sell-off, and again, had already started cutting. Then they did an emergency, and in 2001, the emergency cut was the first set of cuts. It wasn't here. The emergency rate cut was also in January of 2008, as it was in January 2001. Again, after a 20% drop, the Fed panicked, got a bounce with it, and then the bottom fell out of the stock market. Because, again, both times they told us recessions weren't going to happen. And both times they talked about the soft landing nonsense that they say at every rate-raising cycle. They say the same thing. Just so you understand, again, the topping process, 2007 and 2001, followed by the 20% crash to kick off the bear markets, and then the Fed panics, does the emergency cut, and then get a bounce. That's why when you see the Fed begin to have the emergency cut, they're going to pause, and I'm absolutely convinced that they're going to make another monetary policy mistake in pausing, eventually have to do an emergency cut to continue rates because of the coming recession that they're telling us that we're not going to have and that we've clearly avoided. But I guess I'm just stupid for believing the recession indicators that have been reliable. You have recession indicators that have been correct for decades. Nevertheless, I digress again. The herd believes that the rate cuts are bullish. The rate cuts are, in fact, bearish. Again, we had the downturn in the stock market, and again, the rate cuts dropped. Again, the stock market pricing in the recession. The Fed lowering rates to try to combat the recession. Always tell us, oh, it's not going to happen. The recession in the early 90s, again, the same thing. The Fed began to cut rates. We had the rounding bottom under 5% there with the unemployment rate, and we had the inverted yield curve. You'll see these things present at times in history right before we have a recession. Again, notice the inverted yield curve and then the uninverting of the yield curve right before the recession starts. Here in the 90s, here in 2000 and 2001, here in 2007 and 8, right before the recession began. Also back over here in the 80s. Look at what's happening right now. You have the uninverting of the yield curve, the longest period, longer than the 1929, stock market crash followed by the depression and all that. Though we've had a longer uninverting of the yield, or the longer inverted yield curve, meaning that the short-term rates are higher than long-term rates. The 2-year higher than the 10-year. Now it's uninverted. And what does the Fed do? And all the experts, all the economists, rates are normalizing. This is good. No, it means we're going to have a recession. The inverting of the yield curve is warning you something is wrong. That's what this is warning you. Things are out of whack. And then we had the unemployment rate drop down to historic lows, and we began to turn off there. The Psalm rule that I've talked about, which is a 3-month moving average of the unemployment rate, moved over 0.5% off of its low from the previous 12 months, signaling we're about to have a recession. That indicator has been right over and over, decade after decade. Not going to be wrong this time, but look at the curving and the uninverting of the yield curve after being inverted, and then the curving of the unemployment rate coming back up. This is what happens right before the recession. Do you see this? What I'm talking about, it starts moving up off of the lows, and then you get that Psalm rule being triggered. I talked about that at great length of detail, and the Fed starts cutting the rates. The Fed is second-guessing themselves, and again, we saw the 10-year yield soar, representing the longer-term rates, and the Fed representing the short-term rates. They're dropping. You got the Fed second-guessing themselves about inflation. Election with President Trump winning the election. It's all worried, the amount of economic growth. Tariffs, we're going to get inflation. The Fed's all, well, tariffs don't cause inflation. Economic growth, that's a Keynesian myth. It does not cause inflation. An increase in the money supply and an increase in government spending, which we now have we just had $7.5 trillion of most money spent in 1 year in history. And we're running, $2 trillion deficits as far as the eye can see. That's what creates inflation. But we have the same recipe here for recession that we've had at these other time periods. And again, we've reached full employment, and again, we're moving up off of the lows. We've had the uninverting of the yield curve after inverting for the longest period in history, bound to move into recession, and that's what this is telling you. And there are indicators, but people repeat this, we're going to get this soft landing, and you get all the experts saying this, and again, they all say that, and the people at the Fed and Powell, Powell's telling us now had a soft landing, it's clear we've avoided recession. They all believe this. The elites, the educated, talked about the fairy tale of the emperor's new clothes, and that's why. Children's fairy tale helps you understand why they all say this. The Fed says, we're going to get a soft landing, and all the people on the financial channels. I told you a couple of months back, I was watching the financial channels, and one guy said, we're going to have a recession, and everybody on the panel attacked the guy for daring to make such an absurd statement. We're going to have a soft landing. And again, Emperor wanted a new suit of clothes to see who was serving him. He was told a new suit of clothes would make him wise and be able to know weavers. He was told that he would allow him to know who was properly serving him in his kingdom and who wasn't in his court. You know the story. The weavers garment, and they showed it to the king, and the king couldn't see it at first. It was invisible, according to the weavers, and only the wise could see it. And all of a sudden, the king didn't want to come off as stupid, so he said, of course, I see it now. Yeah, beautiful, beautiful. Right on the clothes, the invisible garments, members of his administration, part of the royal court there came in, and the king was naked in this so-called invisible garment, his new clothes. All of his administrators said, what a beautiful garment, because they didn't want to be perceived as stupid. They went along with the charade. And so the king went out and, the emperor went out and wanted to do did a parade among the people, going through the city, letting the people see his new garment. Full pointed to the king and shouted out, "The king is naked." Point of the story is that the Fed's telling us, we've had this soft landing. all the elites and all the experts go along with this fairy tale, because if you don't go along with it, you're considered a nincompoop, a Neanderthal. You're considered stupid. That's why they all cling to this stuff. Now, the conference board's leading indicator is warning we're about to have a recession, but yet they're telling us we're not going to have it. They ignore their own indicator. Claudia Sahm, who's experts, Claudia Sahm, whose own indicator, the Sahm rule, which is very reliable, one of the most reliable indicators, again, as I've talked about, is telling us we're about to have a recession. Claudia Sahm is telling us, nope. And again, doesn't believe her own indicator. The conference board. Absolutely incredible. Have a recession. Now, again, this soft landing myth, let me just address this real fast. And again, these supposed soft landings. We had in 1994, 1995, we had this soft landing, the Fed rate raising campaign, and 1984, 1985, had a soft landing. It was part of the larger cycle. We had just come out of recession here. The Fed began to raise rates back up. It was part of the larger cycle, okay? Unemployment rate never dropped below 5%. We had just come out of a recession and it started coming down. We were still at 7 to 7.3% with the unemployment rate. We never had an uninverted yield curve, or we never had an inverting of the yield curve, and it never uninverted. And we didn't have the Sahm rule being triggered. We didn't have recession indicators. We didn't have the LEI. We didn't have warning signs at all. We just had, in the larger cycle, we had in the recession, they dropped rates from 20%. They began to push them back up, and then they dropped them some more towards the end of the recession, and then they dropped it. It was part of the larger cycle. Same thing over here with the rate raising campaign cycle. After the recession in the early 90s, rates continued to drop, and they went back up. They started going back up. They went down a little bit and back up a little bit and down, and then again back up. But part of the larger rate raising cycle. Again, here, we never had full employment. The lowest unemployment rate was 5.4% in the so-called soft landing. It was never down below 5%. Considered full employment. We never had the uninverting of, or we never had the inverting yield curve, the inverting of the yield curve, and then the uninverting. It never happened. We never had the LEI, warning of a recession here. We never had other recession indicators like the Sahm rule triggering. Unemployment rate in both of these cases was in that larger declining cycle until it did reach full employment in these cases. But again, it's this fairy tale of this soft landing stuff that I talk about. Again, even if you believe this nonsense, again, we've had the inverting of the yield curve, now the uninverting of it. We've had the full employment, and we've now moved up off of those lows. Now, if you want to talk about a soft landing, I'll believe a soft landing. When all the recession indicators are flashing, we don't get a recession. That would be a soft landing, not this fake stuff that they talk about, where, again, we're still in an economic expansion in both of those cases. It's just the Fed likes to act like they can, micromanage the economy and they can control it. Actually, their policies are the ones that create much of the problems. These so-called soft landings in the 80s and in the 90s here, again, recession indicators were not flashing at that time. We did not have full employment. We were still recovering from the recessions and in an economic expansion. During the 70s, we didn't have, or didn't reach in the late 70s going into the early 80s there, we didn't reach the full employment. We were at 5.8 was the lowest one there. 1979, a stagflation of the 70s. We had a wave of stagflation in 73 to 75. We had another wave of stagflation during the period of 78 to 1980. The recession problems and all the inflation problems associated in the 70s. We still had the inverting of the yield curve and again, associated with both of those, associated with both of those recessions. But again, the full employment, we've had that, the inverting of the yield curve and then the uninverting of the yield curve. We've had that. These things are associated with the recession, and now the Fed is cutting rates. And again, they're telling us they're going to pause, and maybe we get 2 cuts in 2025. Well, we're going to get a whole lot more because the Fed is being blindsided once again by the recession that is about to start. And again, this is things that occurred right before the recession started. If you can see that, again, we have the same thing taking place, the rounding bottoms here with the unemployment rate, the yield curve and the uninverting of the yield curve after being inverted, and then the Fed beginning to drop. And again, now the Fed's second guessing themselves. But again, this is what happens right before recession. So we are going to have the recession. These people on social media and on the financial channels telling us that we're not going to have it. Fed telling us we're not going to have it. What happens before every recession happens at bull market tops, before bear markets start. Human emotion never changes.